started or talked about command economies and the role of government. We talked a little bit about government. I'm going to go ahead and interject taxes in at this time. So um, a tax is just a required payment to a local, state, or national government. We should all know that. And obviously the purpose of taxes is money for the government to operate. Another term that you will see used when they're talking about taxes is revenue. So when the government starts talking about raising revenue, they're talking about raising taxes. This power actually comes from Congress, and we know Article 1, Section 8, since we studied the Constitution, we talked about the expressed powers. The first power that Congress gives, or is given from the Constitution, is the power to tax. The individual income tax, where they actually take money out of your paycheck, comes from the 16th Amendment. You should also know that. 3 different types of taxes, and you have to be careful because I'm going to say types of taxes, and that means different things each time we use it. In this case, what we're talking about is what percentage are they taking out of your paycheck, or out of your income, I guess. So a progressive tax, progressive just means it gets bigger, and so if you think about it getting bigger, the bigger your check is, the higher percentage you're going to pay. So those people who don't make very much money, they're going to have a small portion of their income taken out of their check, or a small portion of their income going towards that particular tax. If you make a lot of money and your income is very high, you're going to pay a larger percentage. And an example of a progressive income tax is the federal income tax. If you're in high school and you make less than $10,000, you will get all of your income, your federal income tax back. All the way up to if you are making the most money, they'll take 35%. So we have different tax brackets, but the more you make and the higher your income, the more percentage of your income they will take. Proportional is just what it means. It doesn't matter if you make $10,000 or if you make $10 million. Everyone will pay the same percentage regardless. So our Indiana state tax is a flat tax. It doesn't matter if it's you're going to pay 7%. I pay 7%. Your wealthiest people here in Indiana pay 7%, which is different than the federal income tax. I will pay roughly, between 25 and 30%, and you guys pay 0 because you make less. A regressive tax is actually one where a person's percentage of their income, or the percentage they pay, is actually higher the lower your income becomes. Sales tax tend to be regressive, especially if necessities are taxed, and we'll talk more about that later when we actually look at this. Now, if we take necessities out of that, we're talking about a different story, but if you are paying a sales tax on food and clothing and shelter and things like that, then it's a regressive tax. An effective tax rate is different than a nominal tax rate. The effective tax rate is the percentage of your income that is paid towards tax. This rate is used to determine whether the tax is progressive, proportional, or regressive. The nominal tax rate is the stated rate, like 7% Indiana state sales tax. So that's the nominal rate, which is different than the effective rate. And make sure you get this formula down in your notes, because the effective tax rate, what you're going to do is you're going to take the dollar amount of your tax that you pay, and you're going to divide that by your income. So you may pay 7% in Indiana sales tax, but do you buy everything you buy? Do you pay a sales tax on? You don't. And so you're only going to take the dollar amount that you pay in that sales tax. And when you divide your income, or divide that by your income, then the effective rate is actually less than that. You don't pay 7% of your income. You only pay 7% of those things that you actually buy. And we are going to do lots of math, and we're going to calculate lots of taxes. So I just want you to know the effective tax rate and how it's calculated. It's the percentage of your income that's paid towards a tax, and you get that by taking the dollar amount in tax, divide that by the income that you make, and that will give you your effective tax rate. That way we can tell, are people who are making greater incomes or higher incomes paying more or less or the same as everyone else? If they're paying a higher percentage, then it's progressive. If higher incomes are paying exactly the same as low income, then it's proportional. If people who are actually making less money pay a higher tax, then that tax is regressive. The nominal rate, Indiana sales tax, is 7%. Tax bases. All we're talking about is what goods or services, what we're going to tax, or what the tax is based on. That's why it's called a tax base. So what good or service is this tax subject to? So the tax base for the income tax is your earnings. So we tax your earnings, and that's the income tax. Corporate income tax, the tax base for that is corporations. They're going to take your corporate profits and they're going to base your corporate income tax on how much you make. If you own real estate or other property, then you are the tax base for the property tax. You're the people who are going to pay that particular tax. Sales tax, the tax base for that are goods that are sold. So if you purchase something, then you're going to pay that has a sales tax. Services, and you need to write this down, services are not taxed. So doctors and lawyers and accountants and housekeepers and maids and cooks and massage therapists, all of these people who provide a service. When you go get your hair done, it's a service. You're not walking out with a good. They do not charge you a sales tax. Measuring the fairness of tax, we're going to talk about two things here. And the first one is benefits received. And a benefits received tax is those people who receive the benefit are the only ones that are paying for that. If you are paying a gas tax, that is going to go towards roads and bridges. You receive the benefit of driving on the roads, using the bridges, those sorts of things. So we pay for that through a gas tax, which means only those people who drive are the people who are paying the tax, because you're the one that are benefiting from that particular product or service that the government is providing. So the benefits received means only those who use the good or service pay the tax. Only those people who drive on the roads and use the bridges are paying the tax, because they're the ones that are buying the gas, and that's where the tax is coming from, the gas tax. The other type of or ability to measure if this tax is fair or not is the ability to pay. The more ability you have to pay, the more you actually pay. And this is where we're looking at a progressive income tax, or a tax on, like here in Indiana, when you buy your license plate. The newer your vehicle, the higher your excise tax you pay. So each year, your excise tax on your license plates actually goes down until eventually you're really not paying any tax whatsoever because your vehicle's sold. So we look at the ability. Those people who are purchasing very expensive vehicles obviously can afford to pay more, and so their ability to pay is higher. So progressive taxes, the people who make more money actually pay a higher percentage.